So what we'll talk about today is, and I've got some notes here if anyone wants. So if they want them now or they want to take it with you, you can go through those. We're going to talk about just basic fundamentals of starting your business. Get a business plan. Comment on name and logo. Then what type of entity? We got an attorney here today who's perfect for that. I'll touch on some of those issues you need to talk about. Then I'll get into my expertise, which is the tax aspects of different types of business entities. We'll talk a little bit about what I call the entity concept, something I hear often misunderstood by my clients, and the accounting therefore, and then some financial reporting documents that you should think about and try to understand as you go into running your own business. So business planning. Nick would have mentioned vision and mission. When you start your business, you probably have an idea in your head what you think this will look like in the future. That's your vision. You probably want to craft some sort of mission statement. It's probably more of a marketing thing, but it also helps you focus on what you're actually trying to do. What are you trying to provide? To whom are you going to try and provide it? And where or how are you going to provide it? Over the internet or through various stores or a retail outlet or whatever. So think about that. Make sure you've got that right. Make sure you've got a business case. What are you actually going to, how is your business actually going to make any money? I mean, I know that sounds, maybe it doesn't sound very nice, socially aware, but you have to be sustainable. A business has to make profits. Even non-profits have to make enough money to fund their projects. So you need to make sure that whatever you're planning on doing is profitable. I mentioned SpaceX. I've just been reading a book on, I think it's called When the Heavens Went on Sale. And it's all about these space industry companies that came in the wake of SpaceX. And SpaceX, as everyone knows, set the goal of going to Mars. That was Elon Musk's big thing. I'm going to go to Mars. Well, how are you going to make money doing that? And he realized very early on that if he could get a network of satellites into low Earth orbit and he could connect them, he could sell for $30 a month to a fraction of the 7 billion population of the world an internet service. And run that math and do the business plan, and you find out there's your viability. So do that for your business. Figure out what it is that you're going to do. Does somebody want it? What are they prepared to pay for it? And what's it going to cost you to provide that? Make sure you got that right. Then set yourself some objectives. Don't go crazy. Make sure they're specific, measurable, attainable, realistic, and target related. Make sure you got a target. I'm going to have sales of 100,000 by next December or something. But just give yourself something, preferably in writing, not too many of them, something that you can focus on. So that's just some tips on business planning. And there are a lot of people here. Todd will be able to help you with some of that stuff as well. Business name. Everyone dwells on, what am I going to call my new business? What picture? And you spend hours on designing a logo, and this is going to look so cool and unique. I'm a little bit cynical. Who cares? But yeah, you do need branding. And if your business is a success, you need that branding right up front. So you need to talk to someone about whether that name exists. Is there already a business with that name? Is the URL available? Do you want a .net or a .com or a .biz? When we did B2B Solutions Group, there was already a B2B Solutions Group .com, but there wasn't a .net, so we snagged that. Tip I got on registering a company: make your business name relevant to what you do. It just makes things easier. I mean, you can be Joe Blogs Inc. and then do a DBA or try and describe your business somewhere else, but it's just confusing. Why don't you just call your business what it is that you do? So there are a lot of people here who can help you with branding and names and websites and all that sort of thing. So choosing your entity. I'm going to touch on 4 entities that I come across quite often. There are many others, but I don't see them that often. The four are sole proprietorship, limited liability company, corporation, and a non-profit. So a sole proprietorship, you probably know, it's real easy. You just start up, get into business, put yourself out there, create a website, say I'm doing XYZ, and provide the service. But if you do something wrong and somebody can have a go at you, you maybe want to have some protection. So you might want to go to the next level and form a limited liability company. That allows you some protection in case something goes wrong in your business and somebody wants to sue you. You'll get some measure of protection. But get an attorney to help you with that, because there are regulatory issues around it. And the next level up is a corporation, a more complex structure. Again, attorney will tell you what documents you need for that. But it is a valid structure, and the advantage, I think, of the corporation is that because you've got shares, if you intend to grow and become, and bring other investors in, it's easier to offer those shares to new investors, easier than a members' equity in an LLC. And then a non-profit organization. Non-profits are not owned. Nobody owns a non-profit. B2B Group is a non-profit. It's not owned by anybody.
How's everyone doing? I just want to make sure everyone's good. Yeah. Okay.
But a non-profit is appealing because there's no tax. But there may be some tax, so we'll talk about that. But non-profits are really easy to register. You can just go to the Secretary of State website, fill in a form, and you send it in. But as I say, I always recommend talk to an attorney about it. Yep.
What's the difference in like a trust, like nonprofit, and just a non?
So a trust is not owned, but it's formed by one person saying to another, I'm giving you some stuff, money, assets, whatever, for you to look after on behalf of somebody else. So it's like a document. It's like an agreement between three parties, or two at least, to say you manage the stuff on behalf of beneficiaries. I shouldn't be explaining this. I think we have an attorney here who can explain that, but that's a trust. And you typically I don't see them for business. You can have business trusts. You can have S-Corp trusts. So we do deal with trusts, but very much from an estate or a creditor protection or inherited estate type of situation, not from a business situation. Yeah.
I think one of the more important aspects, I agree with everything you said. What I tell my clients when it comes to trust is that they don't offer any limited liability protection, like you said.
Excellent.
It's also very important to understand that all it really does is bypass probate. So you're really doing that for transferring your assets to heirs or someone else on the probate. So you're not doing that to run a business. You're doing that to transfer assets.
That's excellent. That's exactly what I was talking about earlier. Our group here has got that expertise. So thanks. So let's talk about tax. I am allowed to talk about tax law. I know a little bit about that. So a sole proprietorship, as I say, no registration requirement. You can just go out tomorrow and say, you know what, I'm going to sell widgets. I'm going to create a website, and off we go. I'm going to just do that business. But as I say, if DBA, sorry. You may want to create a name for your business. Jason Bassier, doing business as the greatest IT advertising company in the world. Yeah, whatever. But I think Mecklenburg County, you have to go to the county. I think they've got a website now where you just go to their website and you can register your DBA. But you need to do that. The bank, if they're doing the job properly, will not open a bank account unless your DBA is actually registered somewhere. So create a DBA, but again, you have no limited liability. That's all on you. And if you mess up on something, then they'll come after you and your home and your wife and everything else. Limited liability. Sorry, have I got everything else here? From a tax perspective, this entity is very simply taxed. There's a schedule in your personal tax return called Schedule C. And all you do is you put your P&L, your profit and loss statement, on that Schedule C, and that that reports the tax from it. Big thing to note, all of you, you guys are all familiar with W-2s. You all get W-2s probably, or you have got them, and you'll know on your W-2 there's 6 boxes there. One of them, the top box, is your income and the amount of taxes that was withheld. The second 2 is your income and your FICA tax, Social Security, Medicare tax. We call that self-employment income tax, 15%, 15.3 to be exact. So all the money that you make, any profit you make on a Schedule C, on a sole proprietorship, is subject to that self-employment tax. So you make 10 grand profit, you're going to pay $1,500 in self-employment tax, plus whatever your regular tax rate is, your average rate of tax. So that, that's at 25%, plus the state's 5%. You're looking at nearly half your salary, your profit going to tax. Limited liability companies, registration is relatively simple, but again, I recommend you get an attorney to help you with making sure it's the right decision. But actually forming it, you simply fill a form in, you send $125 to the Secretary of State, and you've got your entity. You've got a number. You can then go online to the IRS and get an EIN, a tax number for that entity. Take that to the bank. They'll probably open the account for you, and you're in business. You're limited liability. But I strongly recommend you get what's called an operating agreement. I had a client come to me about 4 years ago. They didn't have an operating agreement. And one of their investors had managed to connive his way onto the tax return as an owner of the business. He was then using that as evidence that he was an owner of the business. And because there was no operating agreement, there was no way to defend it. They must have spent 50 grand in legal fees and about 2-3 years in angst, not knowing where they were going until that was resolved. So get an operating agreement, get it done up front. You probably need an attorney for that. Taxation. There are 2 default taxation positions for an LLC. One is if you're 100% owner of your LLC, the IRS disregards it. They ignore it. It doesn't exist. I think the history of it is that LLCs are state entities, and so the federal tax code doesn't recognize them. So that gets reported as if it was a sole proprietorship. Just for tax purposes, you still have your LLC, it's still out there, but for tax purposes it goes on Schedule C. So you got your self-employment tax problem, extra 15% tax on top of everything else. Have I mentioned everything there? If you have multiple members, unless they're a married couple, there is an exception for married couples, but if you have multiple members of an LLC, it's deemed to be a partnership. So a partnership is an information tax return that the IRS requires you to file. It's a Form 1065. You do not pay any tax for the partnership other than in the states. But federally, you do not have a state tax, you do not have a tax liability, but it will generate a K-1 form that goes in your personal tax return, and the income that you made in that's reported on that form gets added to your personal tax return. LLC, at least partnership income, generally, there are some exceptions, but generally taxed the same way as a single member LLC or sole proprietorship. Also subject to 15% payroll tax on top of your regular tax. Is that, oh yes. A little bit more technical, there are basis limitations. The basis limitations are better. So a lot of people like to start partnerships. It's a little bit complicated, but if you borrow money from the bank, Joe lends you some dough, and you're allowed to add his loan to your contribution to the business. So if it runs a loss, you can still deduct that loss on your personal tax return. You'll see in a moment with S-Corps, you can't do that. So there's some flexibility there, and sometimes what people will do a partnership, they'll start with a multi-member LLC, they'll run it for a couple of years, and then as soon as they're about to swing into profits, they'll convert to an S-Corp. And then partnerships, you can change profit, loss, and ownership. So I had one client where one guy wanted to put in the funding, but he wanted the losses. So the partnership allowed for him to claim 100% of the losses, but they would all share the profits. And you could do that with a partnership. You've got a bit more flexibility around that.
Can I ask you a quick question about
Yes.
W-9s? When you're filling out a W-9 and
Yes.
you're a single owner LLC,
Yeah.
do you do your EIN or your social?
I would do your EIN because you want the whomever you're giving that to, you want them to issue the 1099 in the name of the EIN,
Right.
name of the business. Yeah, yeah. Yeah, W-9s, everyone knows W-9 is a form that vendors will request asking for your EIN. So if you have to submit a 1099, that's really for 1099s. So the IRS can make sure you're not reporting income. Okay, so corporations, again, easy to register, but they have bylaws. Instead of an operating agreement, you need to get with an attorney to get bylaws and maybe share certificates and minutes of shareholders meetings, directors meetings. I've heard, I don't know if it's true, but I've heard that the risk of being found liable, or they call piercing the corporate veil, is higher with a corporation because you have to make sure you do all the regulatory stuff. And LLCs not so much, but again, check with an attorney on that. From a tax point of view, they're real simple. These entities pay tax themselves. So you file a tax return for a corporation, it's called a C Corp, and that entity pays the tax, you don't pay tax on it. So it's quite nice. You know, 21% is the current rate for a C Corp, and North Carolina is pretty aggressive. North Carolina only charges 2% state tax. So you could run a C Corp with only 23% tax being paid by the corporation. It doesn't show on your personal return anywhere. So if you need to keep your personal income low for various reasons, FAFSA or credits or other reasons, maybe you put everything into a C Corp. But here's the catch. There's what's called double taxation. If you want to get your money out of that C Corp, you have to do it, either pay yourself a salary or you've got to take a dividend. And that dividend gets taxed again. So you paid 23% already in the company. Now you're going to have to pay another 15% personally, or whatever your personal tax rate is. So that's the downside with corporations. But I do have a lot of clients, particularly international clients. They like them. They call them C Corp blockers because you just report the entity. You don't have to worry about disclosing ownership, although that's now changing as well. Okay. Then the S corporation that everyone talks about. So what the IRS does is they looked at partnerships and they looked at corporations and said, is there a middle road here that we can help people with? They came up with the S corporation. So the S corporation files a separate tax return. It does not pay tax, but it files an information return with a K1 like the partnership, and you include that income on your personal tax return. So before the Tax Cuts and Jobs Act in 2018, corporate tax rates were like 36-37%. Much better to get the income on your personal tax return because you're probably paying 20 or 25%. Incidentally, Tax Cuts and Jobs Act expires or sunsets in 2025, so we may be going back to that era. So the S Corp came along and said, right, we can give you this opportunity to pay tax on your personal tax return at a lower rate than paying it in the company, and there's no dividend tax. So we eliminate the whole need to declare dividends. Important thing to note is an S Corp is not a separate legal entity. Everyone says to me, do I need to go and register my S Corp? No, you don't. You never register an S Corp. You make an election with the IRS to be taxed as an S Corp. So your LLC could be an S Corp, your corporation could be an S Corp. Sole proprietor can't be an S Corp. It's got to be an LLC or. Big advantage with S Corps, right? Yes. You may remember I said partnerships, whatever you earn from a partnership is subject to self-employment tax at 15%. Well, the S Corp gives you an exemption from that. And it's a bit of a hot topic. The last few years, there's been talk about eliminating that. It's kind of called the S Corp loophole, because basically, you'd be tempted, say you made $100,000 income last year. And you think, well, I don't want to pay 15% tax on it. I'll just run it all through my S Corp, and I'll just put the $100,000 on a K1 and don't have to pay any tax, any self-employment tax. The IRS got wise to that and said, no, there must be somebody working for this S Corp. Surely it doesn't just operate on its own. So we want to see that somebody is running this thing and being paid a reasonable wage. They don't give us a number. It's a reasonable wage. So you define that.
Have you ever encountered an unreasonable wage?
Yeah, well, it is. It's a debate. I mean, even amongst us in my office, we have different benchmarks. I usually say 50% of the amount before owner's earnings. But if you've got staff, then maybe you don't need to take a salary. You could argue that. I don't need a salary. My staff do all the work. So what is reasonable? You just have to apply your mind to it, in my view. And as long as you've thought about it and come up with a reasonable number and you can defend it, then I think it's unlikely the IRS is going to, because it's vague for them too. I mean, they don't have precedent to go on. Basis limitations, I mentioned that earlier. So what happens with so you make $100,000 profit in your S Corp, and you want to take payment of that, you can take a distribution of $100,000 because it's an S Corp, there's no dividend tax, it's a distribution, and you're fine. What if you made no profit, but you borrowed, Joe lent you $100,000 to get your business going, so you got money in the bank, you didn't make any profit, but hey, you need to pay some bills, so you take a distribution. Well, because you had no investment in the business, it's called no basis. All the money that you got to start the business was from Joe's loan. You're going to get taxed on that distribution. It's a capital gains tax. Now, there's a way around that. You can treat it as a loan, but you've got to be careful that you're not just avoiding tax by showing a loan to the shareholder. You've got to pay it back at some stage. And I have got some clients who levy interest on that. They'll lend themselves the money, charge themselves interest, so they don't run the risk of being it's called a distribution in excess of basis. Then non-profit returns, those are commonly called the 990 returns. You know the 990s. Again, no tax generally in a non-profit. There are different levels. If you've got less than $50,000 in donation revenue, you just complete a postcard. It's a 990N. Simple, easy form just to keep yourself registered. If you don't file, you can lose your 501c3 status. So you do need to file if you're within the limits that you're required to file. Beware of unrelated business income. So you could have a non-profit. One of our clients is a non-profit. Sorry. So one of my clients is a non-profit, but they run a pub. And that's fine, as long as the pub is just for the members and for the members to relax and chat, that's fine. That's not different. But they also host weddings there and external events. So we deemed that was unrelated business income, and they're going to pay tax on that income. So we have to actually carve that out of their tax return. We complete a separate form 990T, and we file that, and that's got to be filed with the state as well. North Carolina does not require any tax filing for a 990. California does, but we don't. There's no annual report for a 990 either, funnily enough. But if there's unrelated business income, you do need to file both states. Your business is not you. So many people come and they say, oh yeah, well, this is just my business. It's me. I mean, I can take whatever money I want. You have to think of it as a separate entity, even if it's a sole proprietor. Go and get a separate bank account, get a separate credit card, and create that concept. The IRS does not like commingling. That's where you use the same bank account as to buy business stuff and personal stuff. The IRS doesn't like that. So go out, take the effort to go and get a tax number, get a separate bank account. I recommend a credit or debit card because so many expenses are paid that way these days. And you automatically, by doing that, you're creating the initial presumption that you've thought about what you're buying. You came to Grace O'Malley's, you paid with your business card, you had thought in your mind, this is a business expense, I'm claiming it for business. So in the IRS, if they challenge you and they say, was that a business expense? You're starting from the perception that, yes, it was business. I already made that decision. I thought about it at the time. Now you've got to try and prove me wrong, kind of thing. So that's a good discipline to have. It goes to the whole funding concept. When accountants have double entry systems, which everyone wonders why we have this double entry system. It's ingenious because a double entry system, all it does is says, where did I get the funds from and how did I apply them? Every entry is, where did it come from, where did it go to? And that's how your business is funded. It's a separate entity from you, right? So you invest money in the business. That business now is a separate entity. It owes you. And what did it do with the money? Well, it put it in the bank. And then it took it out the bank and it sold it to a customer. And then the customer paid you. And it goes round and round and round inside the business. And hopefully it gets bigger and bigger as it goes along. And as it gets bigger, it creates more and more retained income, which is owed to you. So there's always these two sides. And if you can understand that, I think it's important when you fund your business and you understand your business that there's a funding aspect and there's a use aspect. And that funding is the finance stuff that Todd was talking about. How are you going to fund this business for the future operations? You can get funding from yourself. You can get it from friends and family. You can get it as equity. You can get it different types of equity. You can get it as debt financing, lines of credit. But just think about that. And I've given some examples there of how you would, of the double entries that you would. Did I give you examples of it? No, I didn't give you examples of it. Yes. You invest money in the business. You debit bank and you credit owner's equity. You put the money in the bank. You got the money from the owner. You sell something to a customer. The source of the fund was the sale. You sold something to the customer. That was a source of funding. The customer hasn't paid you, so that's an asset. You applied it to an asset. The customer pays you. The source of the funds is the asset that the customer paid you, applied to the bank. Everything is double entry, and all the way around, it keeps going around and around. And it's amazing. When you mix up one of those, it pops out somewhere else. And that's why, as accountants, we can find these things. Because there's always a double entry somewhere that's showing up. All right, so last thing I wanted to comment on is just the types of financial reports that you might find useful, and you perhaps familiarize yourself with this. Profit and loss statement. Everyone knows what a profit and loss is. Sales less your expenses gives you a profit. But maybe you should just think about it from this perspective. Generally, most businesses have a trading statement. That's, I sell widgets at $5, they cost me $3, I make $2. That's your trading statement. 2 as a percentage of 5, my profit of 2 as a percentage of my sale price is 40%. That's my gross margin. That fluctuates, and if your business is successful, that will go up. And you want that, you want to focus on that in your day-to-day, and that's what you spend your time working on. But you need to open the doors every morning. So there's a fixed cost element as well that you need to consider. So you often hear people talking about what does it cost to open the door. And often when you start a business, you've got rent to pay, maybe you've got staff, maybe you're doing it all yourself, but maybe you've got rent. So you've got fixed costs that you have to pay. And what you'll find is that those fixed costs, if they equal the amount of gross profit you're making, then you're at a break even. So it gives you an idea that, okay, I know I've got to cover 10 grand a month in overheads, fixed overheads. That's what I can't avoid that 10. So what do I need to sell to make 10 grand a month in profits? And you can translate that up to sales. Then if you know what each item sells, or what each hour sells for, you can translate that back into a number of units or a number of hours You can then take that back a step and say, right, what customers can I go to get that from? And then you're back to your budgeting thing that you have to do. So always make sure that these things link all the way through. Balance sheet. Okay, most people ignore the balance sheet. Balance sheet is my most treasured document. I can pick up, if you show me a balance sheet, I can probably tell you if your statements are right or wrong. And the reason that the balance sheet is a statement in a point in time of all those debits and credits. It's all the assets and all the liabilities. But you don't need to be an accountant. What you need to know is every line on that balance sheet. When your accountant brings you the balance sheet, you should be able to look at any number on that balance sheet and say, oh yeah, that's 5 people who owe me X amount. That's my accounts receivable. Or bank. Yeah, there's the bank statement. That equals the bank statement. Or accounts payable. Oh yeah, this equals these people that I owe money to. If there's anything on that balance sheet that doesn't mean one of those things, there's something wrong. You need to go back to your accountant and say, tell me what this is. And when we do accounting work, that's what we do for our clients. We go through every line on the balance sheet and we say, I've got to explain this to my staff. I don't just want a list of transactions. I want you to tell me what it is. Who owes me what? Who do I owe? I want a name and I want an amount. You should be able to do that on your business. And don't be shy to ask for it. Cash flow statements. Cash flow statements are important, probably initially, and if your cash flow is tight, obviously you need a cash flow statement. The problem with the cash flow statement is it doesn't help you with your trading account. If you're selling widgets again, you're selling a widget for $5, let's go the other way. If you bought the widget for $2, but you only sell it next month, so at the end of this month you've got a loss of $2 because you bought this widget on a cash flow basis. You're $2 poorer, so you think you've lost money, but you haven't lost money because next month you're going to sell that thing and you're going to make $3 profit. But if you just take a cash flow statement, you've lost $2 this month, you made $5 profit next month. It doesn't help you manage your business. We do tax returns that way because there's an advantage. And it's nice from a simplistic point of view. But I really try and encourage people to go for what's called the accrual concept, where you match that $2 against the sale of 5. And we have it in our industry. It's terrible because we'll be working on stuff. And we'll be paying the salaries all along. But we might only finish a tax return 2 or 3 months down the line. So I've got all these losses running, and I'm thinking we're getting crucified. And suddenly, after tax season, we're making all this money. When we haven't. Everything's actually just, if you just accrue everything in the right period, you get a more meaningful statement. So that's my comment on cash flow statements. And then last thing to mention, key performance indicators. Pretty cool to have these. A key performance indicator is really just a number or a series of numbers. You may have several that are key drivers of your business. So if you're a retail business, probably your key performance indicator is going to be gross margin. And then you may look at some other things like retail space and sales per retail space and things like that. But they're numbers that you'll figure out are important for your business. Accounts receivable. If you've got customers who owe you money, you want to see how quickly they pay you. So you can calculate that. It's a very well-known numbers, days collected. How quickly are my customers paying me on average? Is it 30 days? Is it 45 days? Is it 120 days? So that's my comment on KPIs. Is there any questions, any discussion points? Yeah.
You mentioned like being married in the LLC. There's special it's like a special.
It's like a partner is a married couple or something like that. I remember that.
If your partner's in a so the default tax treatment for an LLC, if there are multiple members, is a partnership. So technically, if you and your husband owned a business, you would file a separate 1065 partnership tax return, and then you'd file it's your personal tax return.
So what happens if you aren't married?
Yeah, well then,
Because that's what we're going into.
sorry, John can't hear your question. So the question is, what happens if a married couple is no longer married? Do they still get to not file the partnership return? Or no, you have to then file. If that couple is no longer married, then you have to file a partnership tax return. And
So the extra 15%?
the 15% should still be would be there already. You should already be paying the 15%.
Okay, that's so it's going to affect that more.
So yeah, so Sherry's asking about the 15% if you're a married couple. The profits from a partnership, if you're filing as a partnership, then you're paying the 15% payroll tax, whether it's as a partnership separately or as a Schedule C. I had one client where it was owned by 50-50 by a married couple, but we had to do 2 separate Schedule Cs for them because they wanted to reflect their respective profits, but they paid 15%. In fact, that's why. They wanted the 15% to go to the Social Security Administration as record that was their earnings for the year. But if you want to avoid the 15%, you've got to go S Corp. You've got to make, yeah. Well, then it doesn't apply. S Corp, you don't get to do that with an S Corp. S Corp, you have to file a separate information return. It's an 1120S, separate tax return. But an LLC,
Like 2 separate tax returns.
yeah, you have the 1120S, then you have your personal, and if you're officially divorced, then you have the 1120S, the business tax return, and then the one partner will file her tax return, personal tax return, and the other partner will file his or her separate tax return.
Hey, Craig.
Yeah.
Quick question on the S-Corp and the self-employment tax. So, let's say the S-Corp has profits of $100,000, and you pay yourself a reasonable salary of $100,000. You're still paying that self-employment tax on the reasonable salary, right?
You are. But that's why I mentioned the W-2, because you've got the FICA tax, which is the same thing. So if you take a salary of $100,000, the FICA tax is 15%. Effectively, you're paying the self-employment tax.
So in that scenario, you're essentially cutting your self-employment tax by half using.
Now, what you should be doing is, if you've got a profit of $100,000, you should take a salary of $50,000.
Yeah.
Because now you're going to pay FICA tax, self-employment tax, on $50,000. The other $50,000 comes in via the K1, free of self-employment tax, and that's legit. That's allowed. And then what you do on top of that is you set up a SEP, so that you can take a portion of the 50 out as a SEP contribution, and Alan will help you with that. And there's no, if you do an employer contributed SEP, then there's no 15% on that either.
It pays to have the experts, right?
Sorry?
It pays to have the experts.
Well, I think that's one of my themes here. Is I wanted to point out that there are people in this room who can help with these things, and yeah, I think that's one of the concepts we're trying to create here. Is if you're a small business and you want to get going, come to one of these meetings, and there's probably 5 people in here who can help you get going.
Which is a nice segue into, if you know that you're in an industry that is not represented in our group and you would like to pursue perhaps membership, as
Yes.
Tom already mentioned, there are some openings available, and you can ask Alan, Tom, or another member. We have opportunities.
Yep.
I think
Good.
the attorney was represented multiple times in this dialogue.
Gentle push, right?
I think there's an opening that came today, right?
I think so. If not, we'll vet it out.
But it's not just the attorneys. You need to sell.
Yes.
And not all of us are good at selling, so you need to talk to Chad, and he can help you get customers. So you need finance, so you need budgeting, you need IT. You're going to need ultimately to exit. So there's a range of skills. You need the branding and the marketing and the video and the websites. Sorry, you were going to ask.
No, I was just
Comment.
gonna say, I really appreciated this presentation.
Yeah.
When I do a similar one, I say multiple times, talk to your accountant, talk to your accountant. So it's cool to hear, you know, on the flip side,
Yeah.
kind of a similar conversation.
Well, it's right, though. I mean, you're 100% right. I mean, the CFPs do the same. Yeah.
And when I advise clients, you know, a lot of the best relationships are when both of us are in the room, you know.
Yeah,
That's,
100%.
most streamlined.
100%, yeah. Any other comments or anything?
Great presentation.
Thank you.